All right. Yeah, no problem, Richard. Richard asked the question if we could talk about time decay and calculating the cost of holding something. So, obviously, theta, time decay. So, an option is the extrinsic value of the option is a decaying asset. So, what do you get? There's always a give and take to that. Well, you get the deltas and gammas from those moves, and that's why you pay for the decay. The big thing that you want to know about is, well, theta increases as the time to expiration decreases. Let me see if I can find that. Let me see if I can find that chart. Shouldn't be too hard to find here. All right, and let's see. Here's a decent one. Sorry, a little bit slow here. So this is what you're seeing, and you can see that out in time, there's very little time decay because the option has a lot of time to work itself one way or the other. As the time to expiration decreases, then what you're looking at, there's a certain truth and finality to an option. It is either one of two things at expiration. It is nothing, or it's underlying. There's no, well, it's kind of in the money. So you can see where that extrinsic value really starts to ramp up. It's not a straight line. It's a logarithmic line going up to 0 days to expiration. Yeah, Rajesh, that's exactly it. We had talked about that it jumped up right when we put the signal out. So that's the signal. Okay, so how do we calculate that cost? Well, it is expressed in, we'll just keep Yum here up on the board. It's expressed in cents per day. So let's just say that we're going to buy an at the money call here. An at the money call going out to August 30th. And we can see what this looks like in time. Let's keep today, and then we'll go out a week. And you can see that if we stay right here where we're trading at 116.47, you can see how this is going to, over the course of the week, is going to lose theoretical money. Now, there's no guarantee because here's your theta number. So this is going to decay by 5 cents, theoretically. So in that theoretical example, if we close here at 163, tomorrow morning, all other things being equal, it'll be worth 158. So, and that decay rate is going to go up. So one of the things that we want to do, one of the reasons why we do vertical spreads, is we can mitigate a lot of that decay. It just went from 5 to 1 by doing the call spread. Again, what do we give up? What is the yin to that yang? We give up the theoretical unlimited upside potential in that call. Once we get above 119, this thing is going to be worth $2, because that's how wide the spread is, less whatever premium that we put in there. So does that answer your question? Any other questions on that? Now, I did record this. It's not a particularly long video. That is, well, this. You can, in some models, you can make them business days. These are calendar days. So theoretically, on Friday, If you're using calendar days, 3 days of decay are going to come out between the end of Friday and the beginning of Monday, or excuse me, it'll be 2 days because you close on Friday, Saturday, Sunday's decay would come out. But you can, depending, like I said, on the model that you use, you can use trading days. This one uses calendar. Yeah, it works the exact opposite way. So theoretically, all other things being equal, the question was, Dale asked, can you explain how much time decay, how that works in your favor? Well, because if I'm short something, excuse me about that, well, that decay theoretically is coming my way. Now, there's no guarantee, like I said, there's no guarantee. This is just, the Greeks are just our way of explaining what the price of the option is. The price of this option can theoretically be anything. It's a price discovery, supply and demand sort of thing. If somebody wants to pay $50 for this August 30th 117 call, they can. They're going to be met with a lot of people that want to sell it to them, but they could. Or if they want to sell this thing down to 5 cents with 18 days left to expiration, they could do that too. But then we would express that in, so let's just say, these things are worth 161 and we open up tomorrow and they're still worth 161. Well, the theoretical decay came out, but implied volatility put that extrinsic value back in there. So it's just a different lever. So if you're short, you're the one that's theoretically collecting that decay. If you're long, you're the one that's theoretically paying that decay. So if I buy a put, time decay works for you? No. No, if you buy a put, then you're just betting on the direction of the underlying. If you buy a put, so buying at the money put, 60 or close to 16 put, I still have decay, but I make money if it goes down. If you sell the put, then you're the one collecting the decay. I still see you typing. So I have to sell call. Yeah, so if I sold the call, sell this 117 call, well, now it looks like this. If the underlying goes down, that's good because I'm short deltas. And I'm going to collect 10 cents of theta per day, theoretically. But what do I give away for that? Well, if this thing rockets up, I am obligated. If somebody exercises the call that they bought from me, I'm gonna have to get short the call at the strike. So theoretically, if this thing went up to 200, I am short from 117, and whatever premium I take in. All right. I don't see anybody typing, so I'm thinking that we're good. You got it, Richard. Thank you for the question. These are the type of things, if we're not going to trade, we might as well learn something or hone our skills. So let's keep those up. Okay, so let me get this out to you guys, this video. I should be able to get it rendered no problem before the close. All right, thank you guys.